at variances in this video. So what I'm actually going to do for this video is that I'll share an actual question, then we'll be learning the types of variances from an actual question, which will talk about all the variances that exist actually. Yeah, so when we look at this question, I'm sure by the end of the video you would have a full understanding on variances, because it's just all about the formulas that you need to understand, the types of variances that exist, because what you just know is that we talk about cost variances. That's the main thing. And you look at what revenue variances are. Revenue is sales, just in case you are wondering. Yeah, then cost variances, what are these things? Material, labor, variable overheads, fixed overheads. Those are your cost variances. Revenue overheads, what are those? Sorry, revenue variances, we said sales. And that's it. How do you find profit variance? Profit variance is just total cost variance and total revenue variance. That's how you find the profit variance. So it's basically going deep into these variances now. Like cost variances, we split them up. What are they made up of? Material, what? That's what you'll be seeing even in the question. Then when you come and sum up all those together, they make what they call the cost variance. Yeah, so let's have a look at the question, of course, and make sense out of all this and get to appreciate variance analysis, because they are just there for control purposes, trying to analyze what happened in an actual result and what should have been the actual result. So let's look at the question. There is this question: a company produces a single product called Wesco. The standard cost and price per unit of Wesco is as below. You have a standard cost card. Usually how variances work is that you have to have an understanding of the standard cost card, so that when you're answering the questions, you'll be easily relating to the cost card, because we get to interpret variances mainly using our cost card, because it shows the standards that should be placed in any given type of maybe item, like material, labor, and whatnot. So this is how a cost card looks. Okay, yeah. So in this video we are just looking at the variances specifically. Okay, there will be another video where we'll just explain the cost card on its own. Okay, yeah. So look at the question now. They've given you the budgeted output, which was 5,100 units. Actual results were as follows. Usually this is how they give you, because when you're having questions on variances, you need the actual results that happened, then now what you've planned, okay, as well as per budget. So you are given, okay, your actual results, have a look at them. I'll go straight into the calculations in this video. Calculate the following variances. 1. Total direct material cost variance. How do we calculate that variance? Total direct material cost variance. Well, I will take a shortcut in this video. An understanding of total direct material variance. This simply means you're going to find the material price plus your material usage. Those two put together, they give you total. Okay, so when they ask you for total, maybe total material, maybe they'll even ask you maybe for something else later on, like total labor. Well, the total is basically you add those two types of variances which are still relating to the same name, right? Like material, you've seen material price, material usage, they have the same name, material. When you add those two, they give you the total. Please get that part right. So I'll find these two first, the material price, then I got the material usage variance. Once I find those two answers, I'll add them and I'll find answer to number 1, which is the total direct material variance. This is just a shortcut I want to take. Okay, so that I don't confuse you much with many formulas and they're like, this is an alternative, you can find the total. So let's go first of all to direct material price, then usage, then we'll get back to total again. Well, let's start with material price. What is the formula for material price variance? It's standard price minus actual price. By the way, I'm just abbreviating. I hope you're getting my abbreviations by the way. Times actual quantity. Please take note of all these things. Standard price minus actual price, close the brackets, times actual quantity. It's just formulas, variance analysis. There's nothing difficult. You find the formula and interpretation. Trust me, it's a simple topic. There are no issues. Just understand your formulas. How do you interpret the answer? That's all. Then now, standard price. Standard price there, go and find it in the cost card. That's how you get these things. Because when you're being asked for any standard prices are already shown where in the cost card. One thing you should know about the cost card is that it shows you prices, okay, of how things should cost as per standard. Yeah, so go to the cost card and go and pick out the standard price on material. Then go to the actual results and it will give you what the actual price, because when you're looking for something that's relating to actual, go to the actual results. That's why you can pick the information from, right? So take note, another point to remember, these prices that are in brackets, they are not like, should I say, overall cost, like a total cost figure. No, these figures of standard price and actual price, they should be taken as per what? Per kg prices. This is your guide. It can be a per kg or liters, because when you look at materials, it's just between these two things they usually look at. It could be kilograms, liters, okay, even have milliliters. There are so many things, but kgs is some form of quantity. Okay, when you look at materials as more of like quantity or that they're ordering, but the prices you're looking out for should either be a per kg price or a per liter price. That's what you're going to look out for. That's what goes in the brackets, nothing else, times actual quantity, which will be given in the actual results. So let's go and pick out the info. We are back to the question. We asked for the per kg price in standard. Go to the standard cost card. What is the per kg price? You looked at the standard cost card on material. It's 40, right? Because you're looking for a price per kg. Okay, you pick 40. What about the actual price per kg? How do you get it? Well, take note that under actual results, that's why you go now, because you're looking for an actual price. Go to the actual results, focus on material, nowhere else. Focus on material. On material there, you'll find that there's what's this? The overall cost of material. They've just given us a token. Material costed 98,900. Now what do? They've given you an overall cost, and you only need the price per kg. Therefore, what do? Divide the cost by the kilograms that are actually available there. That's how you get the actual price per kg. Because you're following the formula. The formula asks you for an actual price. And then we said those prices are per kg. So they've given you an overall cost there for material. But that's not what we want. We want a per kg price. So divide 23 and 98,900. Then you get the actual price. So we can give you 43 actually in this case. Then we go and find the variance outside. By the way, we've picked 40 kwacha per kg from the standard cost card as the standard price. What is the actual price? 43. Okay, we found 43 per kg. When you divide there, close the brackets, times actual quantity. You go back to material. This is relating to material, so they've asked you for the actual quantity. They've put out the actual quantity on actual results as 2,300 kilograms. That's the quantity. Therefore, what do we get? We'll find that we're getting 6,900, okay, as a figure. Would this be, yeah, you would say negative, I know, but we do not put negatives in variance analysis. We only interpret whether it's an adverse or favorable variance. That's all. That's important in variance analysis. Yeah, it's just about saying whether the answer is adverse or favorable. What would we call this type of variance? Adverse or favorable? This is the trick. Use the brackets to interpret. That's what helps. In fact, what's in the brackets? There's an actual price, there's a standard price. If the actual price is more than the standard, then that's an adverse variance. Even put A, because this is the reasoning behind there. Remember, material is a type of what type of variance? It's a type of costs variance. So if costs are becoming more than what something should be, then you're spending too much, right? And such things are called adverse when you're going beyond what people have planned. Yeah. So all costs, material is a cost, labor is a cost variance. So all of them, they have the same interpretation. When actual just goes more, just know it's adverse. That's a good part of being the same category of types of variances. Next, material usage. Material usage, MU variance is equal to the standard quantity, okay, I'll put Q, minus actual quantity, okay, close brackets, times standard price. Please, let's get that part right. standard price. Now, how do we find the standard quantity? That's the next question, because actual quantity, as we just picked it out recently, 2,300 kilograms relating to material. Now, standard, this is why people lose it. When it comes to the standard quantity calculation, get this part right. When we're calculating standard quantity, you might even be asked maybe for another thing like standard hours. Well, the reasoning that we use is that we have to get the actual units that were produced in a period, okay, which in our case is 4,850, and then take these units to your cost card, okay, which is relating to material, because this is material we're talking about. So in the cost card there, when you reach the cost card, why are you even taking these particular units to the cost card? The whole point of standard, what does standard mean? The standard quantity, what does that mean? They're just trying to tell you that find how much material should have been used based on their actual result. Okay, so because the standard calculation is basically something that is based on an actual result. That's the definition. So you're just using the definition to now apply now here. So you go to the actual result, which is the production. I'm just guiding you to make your life easier. You go and pick the actual production units. From those actual production units, go and take them to the proportions up in the cost card relating to material, because this is a material variance. You find that there will be 0.5, right, kg when you reach the cost card at 40, something like that. Now, we are focusing mostly on the first figure, because we want to convert to kilograms. These units, material is being viewed in form of kilograms. That's why we want to focus only on this first figure, the 0.5. What is this figure in proportion to? This figure is in proportion to 1 unit. Please remember that the first figure, most of the time it's just in proportion to what? A unit. 1 unit is equal to 0.5 kilograms. So that statement means there. Therefore, what about 4,850? How many kilos will that be? That's what you're trying to find at this point. So you then have finding that, okay, when you make your proportions, you put your 4,850 there, cross multiply, it gives you, is it 2,425 kilograms as the standard what? Quantity. So just remember, when you're looking for standard quantity, it will be something that will be picked from the actual results. But what are you picking? Actual production units. Then you're now just converting. Okay, they said they produced these units. Now, how much material should they have used? Well, it showed us that they should have used 2,425. You can just rewrite that so that other people can take notes. 2,425 kilos. Well, then they're telling us based on the actual result that then they use how much? 2,300. So that's the reason why we get to calculate standard. We are comparing the actual results and, of course, what it should have been. That's why we get to calculate the standard. So as for standard hours, the same approach as you will see when we even solve labor and other variances. So you just go and substitute this in your formula, 2,425, which is the standard quantity minus actual quantity, which is 2,300 relating to material, times what? Standard price, 40. Standard price is 40. So they said in the cost card. And what price are you picking? It's a price per kg. Remember, what we're multiplying in the brackets are kilograms. You wouldn't want to go and pick a price per hour. That wouldn't make sense. Huh? These are kilos. So pick a price per kg. Then when you multiply these two, I believe the variance you get as material usage is 5,000. Okay, label this figure, adverse or favorable. Well, standard is more than actual. Use the brackets to compare. Remember this always. The brackets will guide you to give the answer easily in what type of variance this is. So actual is less than standard. And what that means is that this would be a favorable variance because you've actually used less than what it should have been, which is better actually. Standard is what something should have been. So you've actually done well. So that's how you know. And material variances, labor, fixed, variable, those are all what they call cost variances. So the interpretation of one of these is the same that will be happening. The rule is that as long as it's a cost variance, if standard is more than actual, it's favorable. If the opposite, actual is more than standard, adverse. That's all. Then put the two variances together. You remember in material price we found this 6,9 adverse. In material usage we found this 5 flat favorable. Put them together to make total material variance. Okay, so put these two together, get total, which is going to give you what? 1900. Why have I found that figure? Realistically speaking, if you get back to the part where we're solving material price, this figure was supposed to be negative. We just ignored the negative. We're like in variances, we do not put negatives, just assign the signs of adverse or favorable. But now when you're putting the figures together, we obey the laws of math. And then we get, okay, this one was supposed to be negative, this is positive. Therefore, it's like you're subtracting negative and positive. Sorry, adding negative and positive, which will give you that figure. But what sign do you put? Because it also has to be labeled. Which one is bigger between the two? The adverse is still larger. That's why you give the sign to use the larger sign to assign the total variance figure. That's all. Please remember these steps even as we got the next variance. We'll move on to the labor variances. Please just remember, variance analysis is not a difficult topic. It's actually quite a simple topic, if anything. Just understand the formulas, even as we'll be seeing the other types, as we are now moving on to labor, and we'll see as the question continues. And take note of the standard calculation. Only when it comes to standard quantity, standard hours, they have the same treatment there, where you have to look at the actual production, then you take it to the proportions. Labor has two. Let's just go back to the question quickly and you see what I'm talking about. Labor variances, the first there, number 4, total direct labor cost variance. We'll do the same thing. Whenever I just ask for total, it's basically just adding those other subdivisions of that type of variance. Like when you look at labor is made up of what? Labor rate, okay, should know that. And the next one, which they are showing below, labor efficiency. This is what makes up the labor rate, the total labor variance. So labor rate variance and labor efficiency. So we find these two again, put them together, we find total. I hope we're moving together there. So as usual, let's just check the details in advance. Okay, if you look at labor, there are some details on actual results. Just take note of these so that when you go to the next screen, you're remembering the figures. There is about what, 8,000 hours in actual results is 8,000 hours. Okay, at the cost of that, we'll need this information. You can look at the cost card. We also need, remember, when you're doing variances, the cost card is very much important. We use it hand in hand with our calculations. So in labor, they've shown us that, okay, have you seen that first figure? 2 hours at, then they put 20 kwacha per hour. So that 2 hours, as I said, the first figure is always in proportion to what? 1 unit. Okay, remember that. So that is what it is. So we need that proportion very soon. Let's just get back to our question, the next board series that we solve. Let's start with labor rate variance, the one they had asked for in number 5, labor rate variance. Well, labor rate variance is equal to standard rate, I'll put SR, minus actual rate, AR, close brackets, actual hours, I'll put AH. Remember that, standard rate minus actual rate times actual hours. Now, how do you find the standard rate? I asked you, I mentioned, that if you're told the rate, a price, anything that's relating to like price, okay? These are all found in the cost card. There's no issue on that one. As long as something relating to prices, it's in the cost card. So you would find that you got the cost card, and mind you, these rates, what are they relating to? They are prices per what, in short? These are prices per hour. This is your guide. When you're looking at labor, just know it's something in per hour basis. Remember your labor costing that you learned. Okay, this is the application now. That's why we learn topics for a reason. Huh? Yeah, so they are now applying. When looking at labor, mostly it's about the hours that are being worked. Then you can look for the per hour price and you put it. So take note in your, remember what we found in the standard cost card. So remember what we found in the standard cost card. If you rewind, there was a 20 kwacha per hour. We will track it, and that's what we're looking for as a standard rate. Then minus what? Actual rate. How do we find actual rate? Well, if you get back again, rewind. That's why I said take note of the information because we'll be using it. Go to the actual results, if you rewind the video, you would find that there was this amount which was on labor, 162,000. As like that was the total labor cost. So these figures which they even just put there that, okay, these are labor hours or what, they all put totals of everything. So now that's what we need in this formula, are per hour. We don't need the overall thing, we need the per our price. That's why we need to get to divide again. So that total which was 162 there, right, in the actual results, because you're looking for an actual rate, divide that total with what? The actual hours, which is 8,000 hours. Remember, when you're looking for something that's actual, don't use any other details, just pick details from the actual results, but relating to what? Labor in our case. So if you divide, what answer we're getting? I think 20.25. Just clarify that figure as well so that we are moving together. So once you divide, you should get 20.25. Okay, as the rate, because you're just looking for a rate per hour. That's why you can't get the overall thing there. Times actual hours. What are the actual hours? Go to the actual results, you'll find them. The under labor there, 8,000. I hope we are also following, so at least we're moving together. 8,000. Then what's the answer for this variance? I think it's 2,000. Please confirm as well. I'm getting 2,000 myself. Okay. Adverse or favorable? You have to answer this. So we interpret from the brackets, please. Actual is more, from what we can just see, the actual rate is more than the standard. Therefore, it's an adverse. I think I've now explained this part. So you can rewind, I've made an explanation of why we're now calling it such an adverse when actually it's just more than standard. It's an adverse, as long as it's a cost variance. Therefore, we got the next one. Labor efficiency, LE. This is equal to standard hours minus actual hours. Okay, close brackets, what? Times standard rate, SR. Well, how do we get standard hours? Remember what I had explained earlier on in the video? They are told standard quantity, standard hours. What is the calculation? Just go to the actual production, 4850, and ask yourself, these 4850 units, we are looking at labor. Labor is in terms of what? Hours. So take it to the hours section and then ask yourself, these 4850 units, like how many hours should it actually have taken? Okay, then they're telling us that their actual hours were 8,000. That one will be easy to substitute in our formula. Now, we're asking ourselves, okay, this actual production of 4850, like how many hours should it have taken? Therefore, it would be like, you would say, okay, if go to the standard cost card under labor, they've shown you a 2-hour figure. What is it in proportion to? It's in proportion to 1 unit. Remember, as I said, the first figure is in proportion to 1 unit. Therefore, what about 4850? You'll find that this will be 9,700 hours. Okay, as the standard hours. That's how you find them. So just remember the calculation. Just for standard hours, standard quantity, the calculation is get the actual production. Go and take it up the cost card and see, okay, what am I talking about? Labor. Oh, labor is showing, okay, 2 hours there. 2 hours for what? 1 unit. So what about 4/8? Then you get to calculate. Then this is basically what even used to happen in labor costing. So you know how these things get to relate now. If you had challenges in labor costing, this is back again. So you just have to get that understanding of how we calculate standard hours, because this was from labor costing. I'm just revising. So you get to substitute in your formula. Standard hours, we found them as 97. Actual hours, 8,000. Okay, close brackets. Then what are we multiplying by? Standard rate. We found the rate already, 20 kwacha. Okay, this is labor. The rate is the rate per hour. Remember what I said. Multiply the two. What answer are we getting? 34,000. Okay, what would this variance be? The actual is 8,000. The standard is 97. Therefore, standard is more than actual, right? If standard is more than actual, what type of variance is this? Favorable. Remember that if it was the opposite, it's adverse. So therefore, how do we find out the total labor variance? The one they asked for now, you can get to it. Therefore, total labor variance is the 2,000 we found, adverse. The 34 we have found, favorable. You put them together, they give you what? The total labor variance, which is 32. As I said, they have different signs, therefore you can't just add them. And as we said, realistically speaking, if you get back to the calculation of how we got the 2,000, that was the labor rate variance. Under normal circumstances, it was supposed to even give us as negative 2,000. So as we said, now when you're coming to put them together, you now remember their signs so that you can do the correct mathematics there, right? Which is negative 2,000 plus 34. Therefore, the answer is 32, right? Yeah, but what sign do you assign there? Which one is bigger here? It's the one with favorable. So the one with the larger sign keeps the figure even in the total labor variance. So if someone asks you what was the total labor variance in general, it was a 32,000 favorable from what we've seen. Next variance is variable overhead. We are moving. Variable overhead variance. Variable overhead, I'll just abbreviate it. It's split in also in two parts. This is what they call variable overhead expenditure. Okay, as we will see, I'll show you very soon. And what they call efficiency, variable overhead efficiency variance. Now let's go and look at the information first. When you look at the variable overhead efficiency variance, well, okay, got the information. Actual results, what is that? Look at actual variable. They've said something below. The actual variable overheads amounted to 26,000. We need this information. And something that you have to know is that variable overheads, they use labor hours. Okay, the question, if it hasn't told you, variable overheads we use labor hours most of the time. Yeah, so when you're looking for the prices on variable overheads, remember it's always a per hour price. Sometimes you're doubting, the cost card will show you. Okay, so go to the cost card. You can even go and prove under variable there. Let me try to zoom in under variable production. You can see there's a cost per hour, like there's 3/4 per hour. So you know that this is used hours as well. So whatever hours which are being used for labor, we use them here. In short, since it's actually just one company, so if you're using hours, you're going to focus on the labor hours as well. So look at the information. There's a 2 hours as well. Remember, the first figure is in proportion to 1 unit. Then they showed, okay, at 3/4 per hour. Okay, we need these figures very soon. And we have been asked, we're on under one number. What's this now? Number 7, asking for the total variable production overhead. But take note, total will do the same thing. Get the two types of those variables, put them together, and then they'll find the total variable variance. What do I mean? Total variable variance is split into two things: variable overhead expenditure and variable overhead efficiency variance. Those are the two, meaning the two types of variable overheads. You put them together, they give you the total, just like we've been doing. So let's go and do the same thing. So we are starting with variable overhead expenditure variance. How do you calculate this one? Standard hours. Oh, sorry, just a minute. Standard rates, okay, minus standard actual rates, close brackets, times actual hours. Very similar. So you know, these are very similar formulas. You know, you can even know they come a format. Okay, they all start with standard, then they end with actual. Start with standard. Like you can even know from material to variable, they just look the same, the formulas. Okay, so standard rate. When just being asked for a rate is a type of, it's a price, like, okay. So when you just ask for rates, prices, we remember it's the cost card. This is how you just deal with prices. Under variable this time, what was the price? And these prices, again, remember they are per hour prices, nothing else. Per hour prices. So we can look out for a per hour price, which was 3/4 they put in the cost card. How about the actual rate? Well, you have to go to the actual results. Okay, or as usual, when you ask for something actual, go to the actual results. But if you rewind our video, we found 26,000 under actual variable overhead. Now that 26,000, that's an accumulative total of everything. Now as we want to need a price per hour. What hours are you going to use here to divide? Remember, they are using hours. Therefore, we'll use the labor hours as well. But where do you pick them from? Actual results, because we're looking for an actual rate. So just remember, these things even guide themselves. You cannot go and pick a standard hours and then come and divide in an actual. That doesn't make sense. So actual stuff and actual results. Then when you divide, you get 3.25. Okay, 3.25. So let me just erase that. Minus 3.25. Multiply that. I'm sorry, subtract that and multiply by actual hours, which is 8,000. Therefore, I'm getting 2,000 as the answer. Again, now what type of variance would this be? If you looked at it, actual is more than standard. Remember, actual is more than standard. Add this. Won't even now waste much time there. Let's go to the next variance. Variable efficiency, the other type of variable overhead variance. What is variable efficiency variance equal to? Standard hours. It just looks like labor. You know, once you understand labor, variable is not difficult because they have the same formulas. In fact, yeah, standard hours minus actual hours multiplied by the standard rate. Very similar to labor. So just as we found the standard hours, the way we took the actual production, made it in proportion to how many hours it should take, we're using the same one. So if you found labor, you just come and use the same ones you found as 97. Okay, we're using standard hours. Like, how did we find standard hours in the previous variance, which was labor? This is the figure we got, 97 if you rewind. Then we're subtracting from actual hours. So again, we're using the same labor ones. So 8,000, we're just picking. Okay, close brackets multiplied by the standard rates. Now be careful on the rates. We are picking from variable. I know we've been using same stuff from labor, but when you're picking the rates, they are relating to what? Variable overhead costs. So you would not want to pick the cost itself now from labor. Be careful on the rates. The rates, pick it from variable. Okay, just the hours is what we share. But when you got the rates, pick from the variable part of the cost card, which is 3/4. When you multiply, what answer are you getting? 551. Okay, let's just confirm these figures. So actually it's 5,100. Yeah, adverse or favorable? Standard is more than actual. Favorable. Therefore we put the variances together. I'm sure now you're seeing the sequence now at this point. When getting total, you're just putting the variances together. We found the 5,1 favorable, we found the 2,000 adverse. Therefore when you put them together, you get 3,100. Again, why are we subtracting? If you look at them realistically speaking, this adverse one, when we are finding it under variable expenditure, it should have been actually a negative figure, but as we said, we just ignore for the sake of assigning a sign to them like adverse or favorable. And then when you come to put them together is now when you recognize the signs they should have had, and then you put them, showing that it should be a 3,100. Which one is bigger? Favorable. Next variance is fixed. So we're almost at the end. Fixed overhead variances. Well, there are two fixed overhead variances. We have expenditure variance, okay, fixed overhead capacity, and fixed overhead volume as well, which is made up of capacity, which I mentioned earlier, and efficiency. Fixed overhead efficiency, fixed overhead capacity. They said together those two make volume. Then of course remember there's fixed overhead expenditure separately known as well. Then yeah, that's what makes up fixed overhead variances. Number 10, we're moving. Total fixed overhead variance. As usual, to find total, you get to add up what? Okay, you have to add up, of course, your fixed overhead efficiency. All those things are the subdivisions of the fixed overhead variances. Fixed overhead efficiency, fixed production overhead capacity. Okay, those things you get to add them together so you can get total. Okay, then of course that's the next variance, which is on 13. So first let's add these two: fixed production efficiency, fixed overhead efficiency variance and capacity. Let's find these two and take note of the information as usual because we need this info. But this time around we're focusing on fixed overheads. So the fixed overheads are showing us on actual results that there are 423 actual fixed overheads. Okay, as per budgets, well, they've just given them in a cost card, so we'll have to come and utilize this information well to get to see these fixed overhead costs. Okay, as of course standard. So take note of all those figures again. The budgeted output will come and use it very well. Just take note of that as well. Okay. So they've asked us for fixed overhead efficiency. Fixed overhead efficiency, what's this equal to? Fixed overhead efficiency is going to be, I'll put E, efficiency. The formula is this. It's just formulas as I stated earlier on. Standard hours, okay, minus actual hours times fixed overhead absorption rate. Okay, I said standard hours minus actual hours times fixed overhead absorption rates. What does that term mean? Fixed overhead absorption rates, just to simplify that, it's the price that they've put per hour in the cost card under fixed overheads. Okay, it's the price they have put per hour under fixed overheads. So that's what you're looking out for. So they mean by fixed overhead absorption rate. If you remember your absorption costing, this should have been made sense, but I've just explained it for the sake of maybe some people have forgotten now this principle there. So fixed overhead absorption rate is basically that same amount which you would see as 34, if I still remember. Yeah, go to the 37, sorry. 37. If you go to your standard cost card, it's a price per hour you're looking for. That's when you pick under fixed overheads. Standard hours. Remember, we're calculating our standard hours. This should now be normal by now. We've been using standard hours in this video, therefore we'll use the same figure that we've been finding because it's the same way they're asking here. 97. Okay, as we found it under labor and under variable. Then actual hours, they've stated them 8,000. Therefore, when you subtract these two and multiply by 37, what do we get? So you find that we'll get 62.9. Favorable adverse. If you remember, our standard looks to be more than actual. 97 is the standard, 8,000 is the actual. Therefore, standard is more. This is a favorable variance. Remember, all cost variances have the same interpretation, whether fixed, variable, labor, material. These are cost variances, have the same interpretation. When you just see this scenario, it's the same for all the cost variances. Therefore, let's go to the other one. They asked on number 12, fixed overhead capacity. Fixed overhead capacity. I'll put just C. What is this formula equal to? Actual hours times fixed overhead absorption rate minus budgeted expenditure. Okay, budgeted. I'll just put B or budge. So budgeted expenditure there. How do we find it, in fact? Because I'm sure actual hours is now very much, I'm very familiar with the actual hours now, I'm sure at this point. Then close brackets are not yet done. In fact, just here, we're actually done just there. Actual hours times fixed overhead absorption rate minus budgeted hours. That's your formula for fixed overhead capacity. Now, actual hours we know it's 8. That will be straightforward. Fixed overhead absorption rate is at 7, which we're multiplying there. Now, what about budgeted expenditure? Well, budgeted, the word budgeted, you'd have to look out for something that's budgeted in your cost card. Let me take you back. If anything, you're looking for something that's just budgeted. You tell about budgets. Budgeted, huh? They've told you that the budgeted output, okay, is 5,100 units. Now we're looking for an expenditure, not units. That's what the formula is asking us that side. So these units, well, look at the proportions to convert to a currency, right? Because that's what we're looking for, is a cost value, but relating to what? Fixed overheads. I don't know if we're together there. We're looking for a cost value because we're under fixed variances. We cannot go to other labor figures. No, that would be wrong. So we are looking at a cost value which will make up budgeted expenditure. But look at this budgeted figure. There is 5,100 units. Now those proportions in the fixed overhead, if you look at the cost card, they are in form of what? Hours, right? Therefore, you cannot just work with the units. The units will have to be like first converted to hours. Then now you can apply that rate, because the rate is in form of per hour. I don't know if we're following each other there. The rate is in form of per hour. Now we want to find the fixed overhead costs on those budgeted units, because the word is budgeted and we have to stick to budget. Okay, so we are going to first convert the 5,000 into what? Hours. And once it's converted into hours, it will be easy to now apply that rate, which will now give us an expenditure. Well, an expenditure is a quacha value. It's a cost. Yeah, so we're going to do that. Take note of the figures. So you had 51 units, but go to the standard cost card. It's showing you that there's a 2 hours at 37. Always the first figure is in proportion to what? It's in proportion to the 1 unit. Remember that. So they was like, okay, 1 unit, 2 hours. What about 5,100? That's per budget, because want something that's budgeted at the end of the day. This will give you 10,200 hours. I hope we are moving. We're not done. We're looking for an expenditure. An expenditure would be a cost figure. Times what? The rate under fixed, because this is relating to fixed. Therefore, what answer do we get? We'll find that this gives you 377,400. This figure you have found, okay, is the budgeted expenditure. Okay, sometimes they give. Now the thing is that this question was also, they change. Questions do not always come the same. Sometimes they'll give you, sometimes they don't. So if they don't give you, this is a procedure. What your guide is, you're looking for a budgeted. The word budgeted is your guide. So you go and pick the budgeted units, lift them up. Now you want to convert them into a cost figure. Now the cost figures were in per hour. That's why we had to first convert into hours. But our focus is use only the figures in the fixed overhead particular category, because we're looking at fixed overheads. Then of course you get your figure there as your budgeted expenditure. Then we get to put in the formula where it was at actual hours 8,000 times fixed overhead absorption rate 37 minus budgeted expenditure, that Therefore, 81,400. Favorable or adverse? When you're looking at a capacity variance, how do you interpret? This is the only variance which is different from the rest of the cost variances. It's the one which just takes an opposite meaning. Okay? Because usually when you multiply the 8,037, not answer, it's given like 296. If you get to punch that, 296 compared to 377. Under normal circumstances, you would say this is favorable, right? Because actual came out actual, you multiply the 8,037, it's giving us a less figure than 377. You'll be like, okay, actual result is less than budget, then that's a good thing. Now in capacity, it's the opposite. Only capacity on all the cost variances which have the same meaning when a certain scenario happens, only in the fixed overhead capacity variance do we take an opposite turn. Here, actual is less than budget, but we are going the opposite way. When actual is less than budget, under normal circumstances, it's favorable, but in an capacity variance, it's adverse. That's the answer. Okay, that's how you would find the two. And I'm sure when you put the two together now, you get what? The total fixed overhead. Of course, we do not have expenditure in our question. We cannot assume things which are not in the question. If there was a fixed overhead expenditure variance, we would have also put it in here and get to sum up all the fixed to get the total. Yeah. The 13th variance was sales. The 13th variance is sales. Sales price variance. Okay, that's a figure. Okay, that's what they've told us. And sales volume variance. Okay, go to the question up there. Sales, you're only relating to something to do with sales. Sales, there's standard price. That standard price you're seeing there, it's just the selling price. They just didn't state it clearly, just in case you're wondering. This standard price is equal to 200. That's sales. Please take note of that. It wasn't just stated clearly for people to easily pick it. That's your sales price per unit, and we will need it in the variance calculations. Please take note of the standard profit as well. We need it in the sales calculations as well. Profit is needed, standard profit. And of course, yeah, there is to work as well. We need the units there, because when you're looking at sales variances, mostly they're looking at the units. Okay, both budgeted and actual. Please take note of those two, 51 and 4850. Sales price, SP, variance. What is this equal to? It's equal to your standard price, okay, the one which was put up there, minus actual price multiplied by actual units, AU. That's all. This variance is just about formulas are very straightforward. So standard price 200. You check the cost card. Everything that's standard brand say price, cost card. Actual price. Well, yet again, if you get back to the question, go back, you go to actual results because you're looking for an actual price. Have you seen that statement which says sold for 1042? That is the actual selling, actual sales total in overall. Now, as remember the prices which we always put, they are not an overall. It's just a pay something. Now, when you're looking at sales, it's per unit. That's your focus. So you're going to divide that total sales figure in the actual results with the actual units that were produced, which is 4850, because it's actual. Do not go to budgets to start dividing. No, we're looking at actual stuff. Total sales figure divided by the actual budgeted units, which are 4850, to get the actual price per unit. So you tell me that when you divide, it's giving you 215. Okay, actual units, how much are they? The same ones are just from looking at 4850. Therefore, what is our sales price variance? You would get 72,750. Okay, how do you interpret this answer? These are revenue. Now, when you're looking at sales, it's a revenue variance. Total different category from costs. Even interpretation is different. When in this case, what is bigger? Actual, right? When actual is larger than standard in a revenue variance, which is sales, it's a favorable thing. Because there's a reason to that. They say that when your actual price is high, I mean you raise your prices more and you've earned more revenue from your sales. Okay, then it's about revenue. Revenue is income. That's a good thing. So when actual price is more than standard in a revenue variance, it's a favorable thing. The next sales variance is volume, SV. It's equal to budgeted units minus actual units, close brackets, standard profits. Please take note of that. Budgeted units minus actual units times standard profit. Sometimes you won't see the word profit, you see contribution. So that's what you would replace. You saw contribution, because contribution is a type of profit as well. Budgeted units 51. Check your question. If you rewind, actual units 4850. Standard profit 60. What's our answer? And this one gives you 15,000. Favorable or adverse? Well, budgeted is more than actual. When actual is becoming lesser, that's a bad thing. You're not selling and you're not bringing in revenue, so it's adverse. So remember the meanings. Revenue variances, they are very specific in how they interpret. Cost variances at least are the same that side as well. But there's a difference between cost and revenue. Please take note. So those are the variances that you need to even know about. Basically, this question has talked about all the variances, if anything. Yeah. So at least once you get to run through everything with this question, you will get an understanding of variance analysis.